Hi and welcome. Our topic for now will be the bank deposit analysis and why it is so important for you to understand. When you or your client are being audited, one of the things that the IRS examiner will do is to conduct a bank deposit analysis. The reason being is to make sure that all income received has been properly reported on a tax return. So what does that mean to you? Well, they will normally ask for all the bank statements for the entire year of the examination. They will also ask for the December statement from the prior year and the January statement from the subsequent year. What they will do is they will take the entire annual for that particular year, add up all the deposits, then they will take the tax return, add up all the income that should have been received from W-2 wage earnings, self-employment on a Schedule C, interest income, rental income from a Schedule E, and so forth, and they will do a matching. If the client deposited $70,000 and all of the income received was $70,000, fine, we don't have a problem. If the income deposited is much greater than what's reported on the tax return, well, we better have an explanation to this. And that's exactly what that's all about. So let's go ahead and dig in. And on the subject here, I have included an example and a sample preparation for you to use when you prepare for the BDA, bank deposit analysis. Here we have John and Mary. They filed their 2008 tax return, Form 1040, and that's being audited. John is self-employed as a gardener and Mary works at the local high school. John reported $50,000 as gross receipts on his Schedule C. Mary's take-home pay, and that's after deductions, her federal income tax, FICA, and so forth, state income tax. For the entire year, it was only $18,000. Therefore, their total deposits, or their total income they received for the year, is $68,000. So hopefully the deposits would equal to the $68,000 that they reported. And also remember that, make sure to, when you ask your clients for the bank statements, make sure that they understand that if you have more than one bank account, that we need all the statements. If you have a savings account, we also need to know, and add up those deposits. And sometimes there are transfers between checking and savings accounts. If you bank with Bank of America, for example, their cutoff statement period, I think, is on the 9th of each month. So if you look at the prior year's December statement, that the cutoff time for that will be January 9th, for example. So there might be deposits made in January of the December statement of the prior year, and vice versa for the subsequent year. The December statement might include a deposit in the January of the subsequent year. So make sure you adjust for those. So here, using John and Mary, I'm preparing my work paper, and I put their name on top, John and Mary Doe, 2008-1040 income. Per return on the right side, $68,000. Per audit, $73,000. Adjustments, 0. And let's get into it and find out why there are no adjustments to the income here. Here I'm using what we call an IFRAC: issue, facts, rule of law, arguments, and conclusion. You have to master this when you are preparing for an examination. Issue: was all income reported on the taxpayer's 1040 per Internal Revenue Code section 61? If you watch the most audited code sections, this is one of the ones that we looked at. And here we explain the facts, that he's a gardener, she's a school teacher, and that's how much money they made. Then we prepare a work paper to show deposits per bank statements, and we add up, we list January through December, get a total. The discrepancy here, the tax return will reflect $73,000. I mean the $68,000, but the actual deposits in the bank account reflects $73,000. So we have a discrepancy of $5,000. And here we are going to address the rule of law. IRC Section 61 states that except as otherwise provided in the subtitle, gross income means all income from whatever source derived. So here the IFRAC, issue facts. Now here we are into the rule of law. Then we get into the argument. The taxpayer states that the $5,000 of unreported income on their return was a gift from the spouse's mother, Mary's mom. Taxpayers actually presented the canceled check from Mary's mom, from the bank, from her own bank account, and a statement from her stating that she gave them a gift for $5,000. So here we have the taxpayer's argument, and you will learn under the appeals section of the study material that the only thing left here will be the government's argument. Should they be arguing that no, this is not a gift and it should be taxable? But here we'll leave it as is, just make it simple. And then conclusion, the additional $5,000 deposited doesn't have to be included on the tax return and no adjustments are made. Master it. Issue facts, rule of law, arguments, conclusion. Understand it. View the state maybe 3 times to understand what it is that we are talking about. Now, another important issue when they do the audit, and that is what we call economic reality. I've seen it so many times. I've been in business since 1994. I've seen returns where their taxpayers' adjusted gross income is $23,000, let's say, and they have a mortgage interest expense on a Schedule A of $30,000 and donations of $5,000, and then they have their, don't forget, they have utilities, they have car payments, they have insurance to pay, medical insurance, they have going out, doing things, internet connection, food, etc., etc., etc. Well, if it's taking you $50,000 a year to live, how can you live on $23,000? So the IRS will contend that there is unreported income and they will assess the income. So another one to really understand economic reality. Please understand that you have got to understand this issue. One more thing I'd like to mention here, and that is people say, well, can the IRS audit me indefinitely? Well, the answer is no. Usually when you file a return, there is a 3-year statute of limitation to audit the return. So if a 2005 return is filed timely, that is by April 15th of 2006, 3-year statute will carry it to April 15th, 07, April 15th, 08, April 15th, 09, and that's it. But normally the IRS would like to have at least a year left on the examination. Therefore, if there's going to be any appeals, and sometimes if they are running late, they will ask you to extend the statute. Now, there are an exception to this rule, and that is if your client did not report or underreported their income by 25%, that will automatically extend the statute by another 3 years. So that gives it a 6-year statute of limitations. If there is an unfiled return, let's say you filed a 2000 return in 2005, then it carries only a 2-year statute of limitations. So whichever is greater, either the 3-year rule or the 2-year rule. There's one other thing I'd like to mention. If it's a fraudulent return, there are no statutes. So if your client has committed fraud, more than likely the IRS examiners will turn the case over to CID, Criminal Investigation Division, for prosecution. That's a whole different subject here. I hope you enjoyed this one. Please view it 3 times at least. Review what I wrote down for you here and master the IFRAC. I thank you for watching.